Welcome to TradeTheMBI.com. This is John. This reports for the 27th. Well, we're still floating right up at the highs, but the ranges still intraday are fairly decent. We keep pushing back towards the ABM yellow, which is very healthy because it just keeps us within that range. We've been fighting a divergence between the S&P and the NASDAQ. NASDAQ outperforming even from its DOC readings. But as we can see here, you got cyan under red, which plain and simple, always buy. It just gets tougher when you get into these extreme levels because you're going to want to see that breakout. So for me, it's one of those, well, okay, if I catch a bottom or a move intraday, then it's just a matter of following it and trailing it, because when it does explode and break out, the short cover will continue to push it forward. In this particular case, you're not looking at a significant quantity. I mean, from the last time we had DOC shorts all the way over here with the cyan all the way up, you can see that propelled a much stronger move. We barely ticked over the zero line with shorts in it. So this has all just been buyers holding up the market as opposed to the other way around. And that can collapse pretty quickly. When it does, it's usually much more force. So here we look at the NQ, and you can see the huge difference between the S&P, the breakout above highs, and continuing to press. And it's been a strong move with cyan under red. And most of this was midterm and long-term buyers in the red and the green. Steel, short-term buyers have completely faded out of this setup. So this is more just about acquiring more. And so you might even think of it as more of the larger corporations buying back shares, that kind of thing. It shows up a little bit differently, at least from an algorithmic standpoint. So in this particular case, a tick up of short-term buyers could really be the impetus to push things. However, positive extremes, so we know that we're coming back to that low of 13,000. So anywhere you get going beyond there, you still know where we're going to be coming back to when we get a definitive transition into sell. And of course, the problems in the Eurozone with leadership and what's going to happen there is just keeping the Euro flat. This is perfectly within the range that the US Fed would love to keep it. I know the Eurozone would prefer to be down in that 116 range. So this is the currency wars that are going to start heating up again, both with China and that. Now that everybody's friendly and happy again, it's going to be currency wars back the way it was before. Gold, again, it's got to have an impetus towards an inflationary move, which, your early signs, of course, Biden had the immigration changes that he wanted rejected by a federal judge. So that's going to hold off an influx of new labor, keeping wages down. So that, and again, this is the real question. The only way to keep interest rates in that low is to keep wages down, because if they rise, then inflation gets out of control. You're going to have modest inflation elsewhere prior to that. That and oil, and reducing the U.S. manufacturing and supply, as well as the Keystone Pipeline, that could be problematic for inflation, for gas prices, and that will definitely send gold to new highs in due course. It's just a matter of waiting for. So from an intraday standpoint, it was very nice. We started with that pre-market dip, and then shot up all the positive extremes, started marking them, didn't even mark the beginning ones, which were all the way back right here to the original range, right around that 3830 level. And once the signal came in, DOC spread, beautiful. Deep move of steel, short-term buyers way low, so you knew you might catch some pops within this, but it was still a decent call, and it pretty much stayed that way. You had this brief spider set up here, so even a turnaround move with coming from the zero and the green moving over, you'd still capture gain, and you would just be re-entering on this turnaround. Didn't even mark that one. And then it caught a little bit of buy before, orange spike, steel crossing below, green was already below, and red actually was well below zero and had just barely spiked and really wasn't making any new moves. So that's one where you can feel a little more comfortable, even if you need to wait a little bit. There were still other points that it did the exact same thing. Just a matter of waiting on it. This one was a little bit more interesting because I get concerned when I get that steel above zero, drops below, and then I'm looking for that orange to make it dip below. Didn't do it on the first one here, and then secondarily did it again and came close, but not quite. And you can see it started to do the press for it, but then it rejected, and you had the green pop up over sign at that particular point, and looking pretty attractive from a shakeout standpoint. It was just as suspect without the orange dip all the way. So it's one of those where I'm like, well, you're going to have to prove it a little bit more. But by the time we got to a P2, it's sort of like, no, that's kind of, your final last stance. And then at that particular point too, it did same zero dip, but this time the orange did go below red. And that did lead to the pop-up. Of course, you might be looking at this magenta and saying, well, why don't I have a mark there? Well, this gets back to that rising gold into those. I knew that if I took it, fine, you might get a couple of points, and if you want to scalp it, that's great, because it is a short move, but you know that it's going to get some turnaround buy attention, and sometimes those can go back and forth for a little bit. Didn't have that case on the secondary one. You can see it flattened out, so that one becomes much cleaner on the rejection right there. And of course, that led to a nice move back down to the algo level before catching up to another buy, another sell, which pretty much neutralized itself. And we're moving close to that full fill of the positive extremes as we've taken out a little bit of the low at this particular stage in pre-market. And it doesn't have a whole lot left to go. Another 3 or 4 points would be well within capturing that very first positive extreme. And that makes it easy. So easy. Love it when it's easy, even in a complicated market. There's getting to be an extension where, at a certain point, even with the liquidity in that, I like to watch those short-term buyer reads on the daily in that, and particularly then flip to 50K, and you start to see that just because the Nasdaq's breaking out momentum-wise does not necessarily mean it's going to carry forward. Everyone's going to be looking to the Fed. Of course, we've always talked about this. You never fight the Fed. As long as they're pumping more money into everything, then it's only one place you can go, and that's the market for returns. But the problem is the percentage gain on those returns is starting to drop dramatically, and the risk factor is escalating. So from a risk to reward ratio, you're going to see some people starting to get a little bit nervous about that, because you're risking far more capital for a far lower return. And I will leave it there, because that is definitely the ultimate risk factor that is starting to build within this market at this current stage. Just FYI, keep that in the back of your minds. As always, though, trade well. We'll talk to you later.